have you with us here on CNBC TV 18. Uh, so two questions, and I think you know what's coming. One is growth seems to have slowed a little bit. Maybe you did point this out, call this out earlier. So on a quarter-on-quarter basis, disbursements are a little lower. So one, if you can guide us towards what kind of growth and disbursement you will see for the year. And second is there is some asset quality deterioration across segments as well. Across most segments, actually. So I think some guidance on that will also help. Go on, sir.
Sure. First on the growth, so the growth has been impacted on two counts. One on the consumer and small enterprise loans, where we had consciously reduced our exposures to the fintech partnerships. We have spoken about it. We started reducing it from Q4 and continue to completely exit this in Q1 this year. So that has had an impact on the overall growth, because that by itself was a 40% disbursement drop compared to previous year first quarter, where this was going full steam on all the partnerships we were having at that point in time. The second area is where in SME we have consciously reduced growth in certain parts of the SME segment, which is the supply chain finance and the loan against shares, because these are not adding ROTA to the bottom line of the company. So we have consciously slowed down on these two segments because this is not turning out to be a better ROTA product. But for this, the LAP has grown. Actually, VF has grown around 7%, which is better than the industry growth by itself. Industry by itself is muted in VF. And this is a general phenomenon that happens in Q1 of any year. And so we are not really unduly perturbed about this particular slowdown. We will see that it will catch up. As you know, we consciously focus on AUM growth, and we still stick to our stance on the AUM growth, that it will be in the range of around 20 to 23% for the full year also, which is what we have already clocked in Q1 now.
Okay, so 20 to 23%.
Just to follow up. So you're saying growth has come off because of specific issues at fintech also. So I had two or three questions. One is on the fintech side. I mean, I think this happened 3 quarters back, right? You're kind of slowed down consciously.
Started slowing down 3 quarters back, progressively exiting one after another of the fintechs. And in Q4, we exited completely end of Q4. So in Q1, we had zero disbursements through the fintech.
Okay, so it's completely now come to zero then, right? I mean, and that's
on
essentially...
the fintech part, which is 25% of the CSL book. The traditional book continues to grow.
Okay, fair enough. And the other question was asset quality deterioration, sir, across the board. So what's the guidance there?
So in every Q1, you would see the comparative to Q4 asset quality will come off. If you see last year, it was even more pronounced, change over Q4 of the previous year, FY24 versus Q1 of FY25. But this year we actually hinted that while the Q4 benefit was not that much, we also hinted that the movement from Q4 to Q1 would not be that high. Last year it was more than almost like 100 basis points. This year it's around 30 basis points, 50 basis points if you compare Q4 versus Q1, and 30 basis points if you compare Q1 versus Q1. Yes, there is a little bit of a higher stress. This is primarily arising out of 2-3 reasons. The early onset of monsoon had pushed the vehicle finance NCL to be slightly on the higher side, because the vehicle operators were not able to operate. The open cast mines are flooded, and that has also resulted in certain segments of the construction equipment borrowers not able to earn, through this particular Q1. As you know, most of our customers are earn and pay type of customers. They are not fleet operators with large pockets. So that is where you will have this sort of immediate reflection of something happening in the economy or something happening in the environment impacting them, but they also quickly bounce back. We expect them to come back with the better.
Mr. Selvan, one of your competitors called out a broad-based issue, a slightly broader issue, and that, of course, I mean, I'm sure you've seen it. You're not seeing that, sir? A generalized kind of stress across segments?
No, we are not seeing that. For us, if we see our only expectation is to have a decent monsoon, which gets completed by the at least by the early September. Unlike last year where it got extended to November, if that happens, yes, the stress will continue into Q2 and a bit in Q3. But if the monsoon, because it has come in early, and the prediction so far is that we will have a decent monsoon and it should also end in Q2. If this happens, the bounce back in the customers.
So can you give us some numerical sort of range to understand this? Because the rise in credit costs was in the first quarter was more than what the market had in mind, 50 bips. And you've explained why monsoon seems to be one big trigger. Now, where will your credit cost be as things stand? I mean, if things normalize, and there's Q3, Q4 as well, no monsoon issues over there. Where will you end the year with respect to your credit costs and also the GNPs? Now, provisions also have gone up in the first quarter, so clearly you see something ahead. So just give us some guidance on gross NPA levels by the end of the year, credit costs by end of the year, and whether you'll need to take higher provisions in Q2 as well.
All of them are interrelated. So the moment the gross NPAs should be similar to what we are closing this year, closed last year, that is around the 3% number. And we expect the credit cost should be in the range of around 1.5%, or 1.4 to 1.5% when we close the full year.
Okay, credit cost of 1.4 to 1.5% full year.
Yes.
Okay, so yeah, that your shareholders will be happy to hear, because that means it will come down from where it is at the start of Q1.
It will come down. So the seasonal fintech exit has created a certain amount of larger credit costs on that segment, which will come off by the time we close the year.
Got it.
We'll see that in one more quarter and slowing down in the subsequent quarters. So that would.
Yeah, no, that's great to understand, sir, because from what you're describing, this looks like a seasonal issue and not a wider structural economic issue that will last through the year. Got that point. Just a quick word on margins as well, because in the first quarter, we've seen, I think, about a 20 basis points compression. What do you expect for the rest of the year as the cycle continues and maybe we get another rate cut from the RBI? Margin expectations for full year?
See, as I spoke earlier, the rate cut benefit has not come through in our numbers in Q1. You will see that rate cut benefit coming through from Q2 onwards, because there is a lag effect of the pass-through happening by the banks as well, even on the ABLR, because that was only the larger cut came in at the fag end of the Q1. So you'll see that benefit coming through. To some extent, on the floating rate book, we may have to pass it off, but on the still we will benefit on the larger fixed rate book. So we will see that coming through. So overall, around 15 to 20 basis points improvement on cost of funds will be clearly visible when we close this year, and that should flow through to the NIM. OPEX should be held at 3%, and if we cut down the NCL to the 1.5% from where we are today, we expect the PBT ROTA should be in the range of around 3.4 to 3.3%.
Thanks a lot, sir, for joining in. We look forward to having a chat with you. Wishing you a good day ahead and all the best. Hopefully, things look up for you.